Are you tired of relying on experts to make your investment decisions? Do you want to learn how to beat the stock market and achieve financial independence? Look no further than One Up on Wall Street by Peter Lynch. This book summary will aid you in learning. Why do amateur investors have a greater chance of success than professional investors? Why selecting stocks based on a company's story is critical. How to learn a company's personality when purchasing its stock. How to create a portfolio using the narratives behind opportunity companies. So, who is Peter Lynch? Peter Lynch is a legendary investor and was the manager of the Magellan Fund at Fidelity Investments from 1977 to 1990. During his tenure, the fund's assets grew from $18 million to $14 billion, averaging a 29.2% annual return. Are you ready to embark on an exciting journey of knowledge and discovery? Let's begin this adventure together and discover the wealth of knowledge and insight that awaits us. If this is your first time here, don't forget to hit that subscribe button and give this video a like. Your support really helps us create more valuable content for you. Old is gold. He holds the belief that investing is rooted in timeless fundamentals. It is not merely about purchasing stocks, but rather acquiring a share in a flourishing company. Moreover, it requires a great deal of patience. In his experience, the most successful investments in his portfolio have taken anywhere from 3 to 10 years to fully realize their potential. Amateur investors are winners. Do you think that investing in stocks requires expert knowledge and analysis to make informed decisions? You are mistaken. In his investment philosophy's first rule is to disregard the advice of so-called experts. As an amateur investor, you are better off focusing on the fundamental principles that underlie the stock market. For example, if you notice that Dunkin' Donuts is opening several new locations in your area, it is evident that they are expanding. You don't need a high-priced investment analyst to tell you this. This knowledge is accessible to everyone. By relying on this type of common knowledge, amateur investors can identify promising companies and choose the right stocks. Stock picking is an art. His initiation into stocks happened as an 11-year-old caddy when he started working part-time after losing his father. Discussions on the golf course taught him all he needed to know about stocks. His college coursework focused on the arts, including psychology, logic, epistemology, and history. He believes that picking stocks is an art, and only primary school math is necessary to succeed in the stock market. Before purchasing stocks, when one begins to consider investing in stocks, it's common to receive warnings from friends and family to stick to bonds or debt, as stocks are deemed risky. While it's true that stocks entail more risk, they are also associated with growth, while bonds are linked to the interest rate of lending. This is a significant distinction. With thorough research and careful selection, a stocks portfolio can reward you for supporting growth, even amidst all the uncertainties. But before you start buying stocks, think through these 3 questions. Question 1. Do I own a house? Before investing in stocks, it's important to own a house as it helps you understand the research required for buying stocks. Just like you wouldn't rely on speculation or news reports when buying a house, you need to conduct thorough research when picking stocks. This involves checking every detail, like plumbing, schools in the neighborhood, and more. The same common knowledge research applies to picking stocks. Question 2. Do I need the money? Investing in stocks carries a higher risk, which depends on your life goals and financial needs. If you require your savings for your child's college education within the next few years, stocks may not be the right investment option. The rule of thumb is to invest only a portion of your money that doesn't jeopardize your life goals. Question 3. Do I possess the necessary qualities to succeed in stocks? To succeed as a stock picker, one needs patience, the ability to tolerate uncertainty, and a willingness to conduct thorough research. Relying on emotions and gut instincts can often lead to bad investment decisions. Sticking with your stocks despite negative market emotions, as long as the fundamentals remain sound, is what defines your success in the stock market. Do you have an edge? If you're an amateur investor searching for the right company to invest in, you'll come across opportunities in your area at least 2 to 3 times a year. It's crucial to look for opportunities in the space you understand well and are comfortable with. For instance, doctors seeking investment opportunities should be interested in medical and pharma companies since they prescribe medicines all day. However, his intuition suggests that doctors who are also investors are more invested in oil stocks than medical stocks. What is your edge? Which area do you understand well? Invest in stocks when you have an edge. This edge can be a professional advantage, such as the doctor example, or it can be a consumer's edge, where you can spot an opportunity just because you were observant enough while shopping or dining at a local retail store or restaurant. The example of Dunkin' Donuts we discussed earlier is an example of a consumer's edge. What's the story behind your opportunity company? After identifying an opportunity stock through your professional or consumer's edge, the next step is to conduct research. Here are some questions to begin your research. Did you identify the opportunity company because of the success of one of its products? If so, delve deeper to understand how the success of that product impacts the overall company results. How big is the opportunity company? Generally, investing in smaller opportunity companies yields higher returns. While large companies like Coca-Cola provide stability, their growth potential may not be as significant in a short time span. What category does the opportunity company fall under? Evaluating opportunity companies based on these 6 categories can be useful. Slow growers. These are mature companies that offer regular dividends, but show minimal growth of 4 to 6% annually. He usually allocates very little space in his portfolio for these slow growers. Stalwarts. These are big companies that grow faster than slow growers and typically show 10 to 12% annual earnings growth. He has stalwarts in his portfolio as they remain stable even during recessions. Fast growers. These are aggressive new companies that grow at a rate of 20 to 25% annually. However, there are instances like Anheuser-Busch, where a fast growth company falls under a slow growth category like beer. Cyclicals. These companies experience regular intervals of sales and profit growth and decline. They may be confused with stalwarts and require careful timing of investment to yield profit. Turnarounds. These are companies that have experienced significant decline, resulting in a discounted stock price. However, they may experience a turnaround, providing investors with substantial returns. Asset plays. These opportunity companies have valuable assets that investors have overlooked. For instance, a company's real estate may be more valuable than its business operations. Your opportunity company has a personality. Is there such a thing as a perfect opportunity company? While there might not be a clear-cut answer, there are certain traits that make a company an excellent investment opportunity. First, the company is engaged in a business that is not flashy or exciting or has a name that sounds dull. This might keep the general public away until the company delivers unexpectedly great results. By then, you could have already made your profits and sold your shares to those who follow the latest trends. Second, the company operates in a sector that is generally considered unappealing or disagreeable, such as waste management, funeral homes, or cleaning services. Third, the company is a spin-off of a larger, highly successful organization. Spin-offs typically have robust financials, thanks to their parent companies, and the parent company wants to ensure that the spin-off succeeds. Fourth, the company is not widely covered by analysts and is under the radar for most professional investors and experts. Fifth, the company is growing and operating in a no-growth industry, and it is even better if it is operating in a niche market. Sixth, the company manufactures products that people need to keep buying regularly. A toy company might sell a blockbuster toy only once during the festive season, but a razor company sells razor blades every day. Last, the company's management is buying stocks, or even better, the company is buying back shares. Insider buying demonstrates high confidence in the company's short-term results. Moreover, when the management owns stock, they prioritize rewarding shareholders by delivering results rather than increasing their own salaries. Share buybacks also increase the earnings per share, as the number of shares in circulation decreases. Once you have used the above criteria to carefully select a stock, it is possible that you may come across a 10-bagger. This term refers to a stock that grows in value to 10 times its initial purchase price, resulting in a tenfold return on investment. Stay away from hot picks. He believes that it's best to avoid buying stocks that the rest of the investor community is chasing, commonly referred to as hot stocks. These stocks often experience a sizzle-to-fizzle trajectory and are therefore quite risky. He also steers clear of stocks in the category of the next company, where the stock prices may have rallied due to the company being touted as the next Tesla or the next Apple. He tends to avoid companies that engage in diversification, which he refers to as diversifying. Such companies tend to acquire other expensive companies in an attempt to grow, but often end up selling or restructuring these acquisitions at a loss. Additionally, companies that rely heavily on one single customer are not ideal for a portfolio. Look under the engine. After selecting the company stocks to invest in, it's important to analyze their fundamentals. Here are 3 metrics to carefully examine. First, earnings line. All stocks have a stock price line and an earnings line, which usually move in close proximity. Even if the stock price line deviates from the earnings line, it tends to eventually converge. Second, the P/E ratio. The price-to-earnings ratio, or P/E ratio, is a quick way to assess the correlation between the company's stock price and earnings. The P/E ratio can help determine if a stock is overvalued, undervalued, or fairly priced based on the company's earning potential. Last, future earnings. Instead of trying to predict future earnings, it's advisable to focus on how the company plans to increase its earnings. This can be achieved through cost-cutting, price hikes, expanding into new markets, increasing sales in existing markets, or shutting down unprofitable businesses. It's essential to understand which approaches the company you're considering plans to take to boost its earnings. Despite professional investors' rigorous analysis of future earnings, there are too many assumptions involved, and actual results often surprise them. The 2-minute explainer. After completing the aforementioned steps, there is one more crucial step to take before purchasing the opportunity company's stock. You should prepare a brief 2-minute response to the following inquiries. What is the reason for your interest in this company? What does the company need to accomplish to succeed? What are the obstacles the company must overcome to achieve its goals? Answering these questions will provide you with a clear understanding of why you are investing in this particular company. It is equally important to note that the answers to these questions will vary depending on the type of company, whether it's a stalwart, fast grower, turnaround, etc. Building the right portfolio. To ensure your stock portfolio outperforms your savings account return, it's essential to aim for a margin higher than the long-term return on bond or savings account that generates a 4 to 6% annual return. The stock market's long-term return is around 9 to 10%, but with thorough research and selecting the right opportunity companies, you should target a return of 12 to 15%. The key question then becomes, how do you construct a portfolio that generates a 12 to 15% annual return, and how many stocks should it contain? The answer to the second question is relatively straightforward. Your portfolio should include as many stocks as you have a competitive advantage or edge in, or you have discovered a new stock that meets all the research criteria we discussed earlier, including the 2-minute response. To address the first question, you should refer back to the 6 categories of opportunity companies we previously discussed. When constructing your portfolio, it's crucial to balance the stability benefits of stalwarts and slow growers with the growth potential of fast growers and turnarounds. By considering these factors, you can create a portfolio that targets a return of 12 to 15% per year. When do you sell? Is it a good idea to sell your winning stocks and keep your losing ones, or vice versa? Both of these strategies are flawed because they assume that the current stock price reflects the fundamental value of the company. However, this may not always be the case. A better approach is to consider the type of company and its current situation. For example, if a stalwart stock has reached an outlier level, it may be time to sell. On the other hand, if a fast-growing company is still showing strong growth, it may be worth holding onto. For cyclicals, it may be wise to sell if the current price is high and the company's fundamentals are not in good shape. Market declines can present opportunities for investors, but it's important to exercise patience and conduct thorough fundamental research. Avoid relying on hearsay or complex analyses. In conclusion, Peter Lynch's book One Up on Wall Street is a must-read for any aspiring investor. Although originally published in 1989 and revised in 2000, the principles of investing that Lynch shares are timeless and applicable even today. His practical advice, based on his years of experience managing one of the most successful mutual funds, will help readers to become more successful investors by identifying potential investment opportunities, doing their research, and having the patience and discipline to hold onto their investments for the long term. If you enjoyed this book, you can find the link to purchase it in the description, as well as investing tools that may assist you in your investments. Do you believe that Peter Lynch's approach is outdated? Additionally, do you have any stocks in mind that fit the criteria mentioned in this book summary? Please leave your comments below. If you are new to my channel, don't forget to subscribe, like, and share. Thanks for watching.